Module Overview. What are adjusting entries? Adjusting entries are journal entries made at the end of an accounting period to update revenue and expense accounts so that they reflect the correct amounts according to accrual accounting. They affect at least one income statement account, revenue expense, and one balance sheet account, asset liability. Why are adjusting entries necessary? To match revenues with expenses, matching principle, to comply with accrual accounting, to ensure accurate net income is reported, to reflect up-to-date balances in prepaid expenses, accrued revenues, accrued expenses, unearned revenues, depreciation. Types of adjusting entries. A prepaid expenses paid in advance and recorded as assets until they are used. Example, prepaid rent 60,000 naira for 6 months. At month end, doctor, rent expense 10,000 naira. Prepaid rent 10,000 naira B. Unearned revenues, cash received before services are performed, liability until earned. Example, customer paid 40,000 naira for 4 months service. Monthly adjustment, doctor, unearned revenue 10 billion naira. Service revenue 10,000 naira. Accrued revenues, revenue earned but not yet received in cash or recorded. Example, work completed but not yet billed. Doctor accounts receivable 15,000 Nigerian naira. Service revenue 15,000 naira D. Accrued expenses, expenses incurred but not yet paid or recorded. Example, salaries earned but unpaid. Doctor salaries expense 20,000 naira. Salaries payable 20,000 naira. A. Depreciation, allocation of the cost of long-term assets over their useful life. Example, 120,000 naira equipment over 5 years. Monthly depreciation equals 2,000 naira. Doctor depreciation expense 2,000 naira. Crescent accumulated depreciation 2,000 naira. Rules for making adjusting entries. Always dated at the end of the accounting period. No cash is involved, must affect one income and one balance sheet account. Follow reversal consistency, some are reversed next period. Examples of adjusting entries. In this course, we will be using transaction type and adjustment entry 1. Prepaid insurance, doctor insurance expense per crore. Prepaid insurance 2. Accrued salary, doctor salary expense per crore. Salaries payable 3. Earned revenue, doctor unearned revenue per crore. Revenue 4. Depreciation, doctor depreciation expense / credit. Accumulated depreciation. Impact of not making adjusting entries. Failing to make adjusting entries can result in overstated or understated income or expenses, misleading net income, inaccurate asset and liability balances, misrepresentation to stakeholders. Adjusting entries versus regular journal entries. In this course, we will be using basis, adjusting entries and regular entries in our table. 1. Timing, end of accounting period. During the period. 2. Purpose update accounts for accuracy. Record transactions as they happen. 3. Involves cash? No. Often yes. 4. Examples. Depreciation, accrual sales, purchases, payments. Key takeaways. Adjusting entries align financial records with real business activity. They ensure compliance with GAAP or IFRS. 5 key categories. Prepaid expenses, unearned revenues, accrued expenses, accrued revenues, depreciation. Essential before preparing the adjusted trial balance and financial statements. Accurate adjustment supports transparency and trustworthiness in financial reporting.